The insurance system in Canada is outdated. This system offers little protection to the consumers. The principal reason for this state of affair is that the business, the operations, and the marketing of insurance products is provincially regulated. As we shall see, provinces under the influence of the very powerful insurance lobby have enacted regulations within their Insurance Act that are detrimental to the consumers. Insurance companies have been allowed to ignore and even break the law in all impunity by the regulators. They have such control and influence over the regulators and the government that they are able to modify existing laws to their advantage and to the disadvantage of consumers. This system of regulated fraud is illustrated in the Great Insurance Robbery. To achieve the Great Insurance Robbery, life insurance companies have compelled various provincial governments to include a provision in their Insurance Act limiting the ownership rights of life insurance policy owners, and this provision reads as follows. Any person other than an insurer or its duly authorized agent who advertises or holds himself, herself, or itself out as a purchaser of life insurance policies or of benefits thereunder, or who traffics or trade in life insurance policies for the purpose of procuring the sale, surrender, transfer, assignment, pledge, or application thereof to himself, herself, or itself, or any other person, is guilty of an offense. Only Nova Scotia and Quebec have refused to do the bidding of insurance companies by not including such a provision in their Insurance Act, with Saskatchewan, who recently gave up and in secret, without any forms of debate, changed its Insurance Act to include such a provision. Basically, this prohibition against the trading of life insurance policies prevents the establishment of a regulated and organized market for life settlement. What is a life settlement? A life settlement is a disposition in whole or in part of an interest in a life policy in favor of a third party for or without any form of consideration. Let's look at how it works. Here you are and you have a life policy and you don't need it anymore, or you can't afford the premium. Your first option is to surrender the policy, and this means terminating the policy in favor of the insurance company, which may give you some cash depending if the policy has a cash value or not. Now, there are other options not involving you surrendering your life insurance policy, but insurance companies don't want you to know about it. They don't want you to use these options. One of these options is to sell your policy to someone who wants to use it as an investment. What is interesting is that the investor will pay you a lot more cash than what you will get if you surrender your policy. In fact, if you have a policy with zero cash value, you could still get a lot of money for it. The next option is to take a loan. However, the loan will not be secured by the cash value. The loan will be secured by the value of your death benefit. In most cases, this means the value of the loan will be much greater than the cash value of the policy. This is like a reverse mortgage, but the collateral is a life policy instead of a house. Insurance companies don't want you to have options outside of surrendering your life insurance policy. This is why they have convinced most provincial governments to adopt this provision against the trading of life policies. This provision establishes a monopoly where insurance companies can dictate the final price of your policy by limiting how much money you can get for it and the amount of premium paid that you can recover. Why do you think insurance companies are so much against the trading of life policies? What do you think is the real reason behind this? What are they hiding? We are lucky we have someone who can explain this in very simple terms. I would like you to welcome the poor bartender. Well, come in. Have a seat. I have a drink for you. You know, life insurance can be pretty straightforward. This is how it works. I buy a life policy with $100,000 of death benefit, and it's going to cost me $1 insurance dollar. Next year, this insurance will cost me $2 insurance dollars. In year 3, it will now cost me $3 insurance dollars for that insurance. I think this is pretty simple, right? The cost of insurance increases with your age. Everybody understands this. Now your insurance agent, oh look, there he is. Well, this insurance agent is not satisfied with this. So this is what he says to you. This is way too complicated. Let's make it simple by leveling the premium so that the premium remains the same throughout the life of the policy. This is how it's going to work. Instead of paying $1 in year 1, you will pay 12 insurance dollars. In year 2, instead of paying $2 insurance dollars, the premium will not change and you will pay 12 insurance dollars. As you can see, the premium of 12 insurance dollars will remain the same throughout the life of the policy. This is shown on this graph. Isn't this great? Isn't this simple? But the insurance agent forgot to tell you several things. First, he forgot to tell you that his commission will now be based on 12 insurance dollars. So basically, his commission is now 12 times greater. The second thing he forgot to tell you is to explain to you that the cost of insurance did not change. It is still $1 insurance dollar, despite the fact that you're paying 12 insurance dollars. So what is going to happen to the difference between 12 insurance dollar and $1 insurance dollar? To explain this to you, this is where I need my cookie jar. There's my cookie jar. Now, if you remember, in year 1, you paid 12 insurance dollars for your insurance, despite the fact that the cost of insurance was $1 insurance dollar. So where does the difference of 11 insurance dollars go? Well, let's find out. Well, look at this. It went into the cookie jar. Now, in year 2, you will pay again 12 insurance dollars. But now the cost of insurance is $2 insurance dollars. So this time it will be 10 insurance dollars that will go in the cookie jar. In year 3, it will be 9 insurance dollars. As you can see, there is a lot of money going into that cookie jar. In fact, at age 100, for a $100,000 life insurance policy, there will be $100,000 in that cookie jar. Now let's jump to year 13. This time, the cost of insurance will now be 13 insurance dollars, but you're paying 12 insurance dollars, so you're short 1 insurance dollar. So where does the 1 insurance dollar that is missing coming from? It's coming from the cookie jar. In year 14, the cookie jar will have to contribute 2 insurance dollars to make up for the insurance cost shortfall. Now let's assume in year 13 that you don't want the insurance anymore, so you decide to cancel the policy. The insurance company will be happy to do this for you, but they will tell you this: we'll cancel the policy, but we're sorry, the policy has no value at all, so you'll get nothing. So what happened to the money in the cookie jar? In fact, where is the cookie jar? It's gone. No cookie for you. Now this is serious. We're talking about a lot of your money here. You know, you did not have to pay this higher premium. You only did it to pay the future cost of insurance. But now you don't need that future insurance, so you should get this money back, right? But the insurer tells you there is no more money. The money is all gone. In fact, since most people don't understand that they have prepaid their cost of insurance, they don't know about this money, and their insurer won't tell. So this is so wrong, but this is how insurance companies make a lot of money. Just in the US alone, we're talking about $112 billion of insurance. That's a lot of insurance canceled on that basis. Hi, how are you? Well, I'm doing fine. What can I get you tonight?
Well, normally I would get a beer, but I'm here on business. I heard that you want to cancel your life insurance policy. Is this true?
Yes, it is true. I don't need the insurance anymore, and it's getting way too expensive.
Well, I have a great offer for you. I would love to buy this policy from you.
Buy it? Why? It has absolutely no value. Anyway, this is what the insurance company is telling me.
Well, the insurance company is lying to you. Remember that cookie jar? Well, I'm willing to give you 50 cents on the dollar in that cookie jar. This means I'm willing to offer you $25,000 for your policy. Don't look at me like I am crazy. This is a great investment for me. When you die, I'll receive the death benefit, and this is when I will realize the value of my investment. I guarantee you I will get a great rate of return. So here's your choice. You can sell back your policy to the insurance company for $0, or you can sell back this policy to me for $25,000. What are you going to choose?
$25,000 is a lot of money, but this seems wrong. Like selling my policy to a stranger. I think it's a bit dangerous, no? This is how insurance companies use fear to discredit life settlements. They use the fact that strangers are buying your life insurance policy and that they will come at night to murder you. But who are these strangers that are buying these policies? Well, these strangers are no strangers at all. They are pension fund companies who are buying these policies because pension funds need long-term investment that provide good returns in order to fund the future retirement benefit that they will pay their members. Do you believe that the manager of these pension funds will plot against you to kill you in order to get an early death benefit? I don't think this is going to happen. Not only pension funds are buying life insurance policies, turning these life settlements into investment bundles, but the Canadian government is doing it also. In fact, the Canadian government is a great buyer of life insurance policy through the Canada Pension Plan. The Canada Pension Plan, or CPP, is a big investor into life settlements. The Canadian Pension Plan has purchased a life insurance company called Walton Re in the United States. This insurance company, Walton Re, is extremely involved in the business of life settlement in the USA. So it seems it is perfectly legitimate, ethical, and right to buy the life insurance policies of US citizens, but somehow it becomes illegal, unethical, and extremely dangerous to buy the life insurance policies of Canadians. What kind of reasoning is this? So why would the government go along with this? Why would the government prohibit the buying of life insurance policies in Canada? It's almost like the government is intent on protecting the profit of insurance companies at the expense of the consumer. Why? Why is this when we have provinces such as Alberta investing in life settlement outside their borders while prohibiting life settlement inside their borders? To answer this question, we have to go back in time. We have to go back to 2010 at the Life Insurance Invitational Forum, where Julie Dixon, who is considered the greatest superintendent of financial institution, made the following remark. This is what she said. I have attended this conference on several occasions in the past, and one that I remember particularly well was in November 2005, where there was a session on the history of toxic products in Canada. A reinsurer provided all the gory details. He said that the first major Canadian insurance industry toxic product was Term 100, offered in the 1980s. This product was a great idea at the time, but the problem was that early years premium far exceeded expected claims, and later years' premiums were far less than claims. The industry had assumed that lapses would be the same as with other products, and they were not. The educated guesses turned out to be horribly wrong, and the consumer response was more sophisticated than expected. So Dixon clearly stated that the insurers had made a bet on the level of stupidity they believed the consumers possessed, whereby these consumers did not have enough intelligence to recognize the value of the insurance that they had purchased, and therefore they would choose to act against their best interests by canceling these policies, allowing these insurers to keep the prepaid premium paid by the consumer, or basically keep what was or what is in the cookie jar. So to summarize, the insurers base their whole pricing and profit strategy on their belief that the consumer was stupid. Because of this, insurers not only lost access to what was in the cookie jar, but now they had to put their own money in the cookie jar because the level of prepaid premium was not going to be enough to cover the future death benefit that was going to be paid. It is important to understand that the lack of a life settlement market in Canada is a Canadian phenomenon, and it is directly linked to the trap that insurers built for themselves by including lapses and high interest rate in their pricing strategy and the calculation of reserves. The writing was on the wall. They were going to lose a lot of money. Now insurers could not accept this. They had to do something. First, they fought against any changes that needed to be made to improve regulation in the life industry, particularly in regards to commissions of service, making certain that people could not get access to a licensed agent for the service of their policies. Basically, they created what we call Orphan Policies, where insurers were able to increase the cancellation of life insurance policies. While working on increasing lapses on these toxic block of policies, insurers were extremely afraid that third party would get involved and see these toxic life policies as investment opportunities. What was bad for the insurer would be good for the investor, but the insurance companies enrolled the help of the regulators, prohibiting the buying of life policies in Canada. At the same time, they started to use their influence by blackmailing agents with the cancellation of their insurance contract if these agents provided any information or help to clients seeking to use a life settlement. A good example of this is from an insurance agent who had his insurance contract with Manulife canceled because he helped his clients with life settlement. The name of the agent was Leonard Goodman, and he wrote a book about his personal experience with this. The book is called Why Are Canadian Seniors Worth More Dead Than Alive? In this book, he tells how Manulife canceled his contract because of his involvement with life settlement. This is what he wrote. Beginning in September 2010, Manulife employed similar tactics against me, and their arrogance and bullying are further exemplified by this excerpt from a letter sent to me by Lester Helsinger, a Manulife vice president. Consequently, you must no longer deal with any of the company's clients in respect of the company's product. In the circumstances, you will not be offered a servicing contract. New representatives will be assigned to service your clients. The company's published business policies prohibit the company's advisors from engaging in the described activities, regardless of licensing, registration, or legislation. So here you have it. You have Manulife putting in writing that it will disregard any legislation and that it regards its own personal practice or the company's practice to be above the law. It's amazing. The existence of toxic life insurance policies in the insurance industry result from three storms that are merging into the perfect storm. The first storm was created by the use of high interest rate and lapse rate into the pricing of life insurance policies. This was very aggressive pricing assumption that never materialized. The second storm was the demutualization of the life insurance industry, which changed the focus of the life insurance company. Under a mutual fund company, policy owners own the insurance company. They are the owners, and they are willing, because they're also policy owner owning life insurance policies, they're willing to accept long-term returns that are average, but that are very stable. With the demutualization, the CEOs are now dealing with shareholders, and these shareholders want short-term returns that are on par with what a bank can deliver, and this cannot be achieved in the life insurance industry. The third storm was basically a game of survivors between life insurance companies. There was this big competition in the life insurance industry about who was going to be on top. And the company that was going to be on top was going to be the biggest life insurance company. And this started a spree of buyouts, of irresponsible buyouts of life insurance companies in the insurance industry. And these three storms merged into the perfect storm, leading to the creation of very, very toxic life insurance policies. You have to understand that the life insurance companies that were the target of these buyouts were life insurance companies who knew that they were in financial trouble because of the future toxicity of their life insurance products. So these companies should have been bought at discount, but that did not happen because there was such a competition between life insurance companies to secure these buyouts. So these life insurance companies that were in trouble were instead bought at premium. This created the perfect storm. So now, today, the life insurance companies cannot be solely reactive if they want to protect their profit margin. They can't rely solely on the lack of services, or they can't rely on the provision of life settlement to achieve the high lapse rates that they need to protect their profit margin. And this created the perfect storm. And it's almost like we're dealing with a scenario coming right out of the movie Rainmaker.
If I had had a bone marrow transplant, I would have had a 90% chance of living.
I hope that you are astonished, as I am, at the lengths to which a wealthy insurance company like the defendant will go to take money from a low-income family and then keep it, by denying a legitimate claim. It's no wonder they spend so much money on their lawyers and their lobbyists and their public relations machine to convince us we need tort reform, that we need to put an end to punitive damages.
I'm asking you, the jury.
Just do what you think is right.
This is where I became a witness and a whistleblower in regards to what life insurance companies were willing to do to address these toxic life insurance policies. We were in 2009, and I was becoming the associate vice president for a life insurance company called Manulife. I was in charge of their direct channel in Quebec. The direct channel is a very important and big distribution channel for Manulife. Because of changes that they were making to that channel, I decided to do an audit. In that audit, I discovered tons of infraction that Manulife was committing in regards to regulation that existed in Quebec. As part of this audit, I discovered also the existence of lapse notices where the agent was unknown and where the branch listed as active did not exist anymore. And worse, these lapse notices, because we did not know what was the address of the policy owners, these lapse notices were simply destroyed. So this means that the policy owners of these policies did not know that their policies were lapsing, and this was highly illegal because policy owners have a legal right to a 30-day notice before policy lapses so that they can address the situation to protect their coverage. This did not happen. So I told Manulife this, and they tried to tell me to forget about the situation because I was not responsible for the enforced block of business, only new business. So I could not do this because I was responsible for these policies and I needed to take action. And this is what I did.
So I sent a letter to these clients telling them they had 30 days to find a licensed agent, or I was going to assign one myself. This is when the shit hit the fan, and this is the only way I can describe it.
So the shit hit the fan because it was found later after these letters had been sent for some of these policies that had an agent with no name, that these policies had in fact an agent that was active with a valid license. So basically we had a situation where policies had lapsed without the policy owner's knowledge and without the agent having received proper notification. And also, you had a situation where these policies had a branch listed, but where this branch did not exist anymore, even if it was listed as active with the regulator. So faced with a potential lawsuit of hundreds of $1,000,000 in regards to these policies that had lapsed, and we're talking about 10 policies a week for I don't know how many years, so this represents a lot of money. Manulife had to bury the affair, first by discrediting me, and second by falsifying and destroying some of the proof in regards to this affair.
Manulife was able to do this with the help of an employee of the regulator, IMF, and this employee was named Jan Paquette, who is now working as a director at the Justice Department in Quebec, Yann Paquette falsified evidence and provided false information to policy owners of these orphan policies, stating that these policies always had a licensed and valid agent. Manulife also did the same thing. It was simple luck that I was able to recover some of the proof in regards to these policies with an unknown agent that had lapsed. Basically, I recovered the proof from an old computer that my son was using. And from that old computer, I was able to retrieve these lapse notices. The proof recovered contained some of the lapse notices that Manulife had tried to destroy. I was also able to recover most of the list of the orphan clients where Manulife and Yann Paquette had stated in various legal documents that the clients in question had a valid agent. This was bad. In this list of orphan clients, we had agents that were dead, agents whose license was canceled because they were convicted of fraud, and whose license was canceled by Yann Paquette himself. However, it was too late. The cover-up had been done, and they were extremely successful, and me, as a whistleblower, was totally discredited. Manulife still remains silent over the whole affair, but once in a while they'll try to shut me up, and usually this involves the threat of a lawsuit. If I speak about this, and I always respond with the same answer, I'd gladly meet them in court because I'll slaughter them in discovery. What can we conclude from all of this? First, it would be easy to dismiss all of this as not being important, but it is important. For example, in Canada, we are moving towards a long-term care crisis. You can't open a newspaper or watch the news on TV without seeing something very negative about long-term care.
Let's bring up this graphic just to get people up to scratch on what you folks have been dealing with. Here's our aging province. There are 1.9 million seniors in the province today. That's 14.6% of Ontario's total population. However, seniors account for nearly half of all health care spending. 14.6% of the population, but half the spending on health care. And it's expected that that number of Ontario seniors will double within 20 years. So this is the proverbial ticking time bomb that we hear so much about. And therefore, let me get you to start, Dr. Sinha, by telling us what the main recommendations of your seniors strategy are to deal with this. Do that. Dad Matthews, I want to show you a couple of charts here that I talked about, that ticking time bomb. I mean, here it is. This is what it looks like. Control room, can we get these ones up here? The future will cost us more. This is medical costs per age. And look at the bulge when we talk about seniors in the year 2030. That line just starts going right up to the heavens. And there is an enormous, what counts there as a $24 billion bulge coming in the not too distant future. And if we can, let's put the next graphic up as well. This is aging and hospital use. If you're a patient 70 years of age and older, this is what the future looks like here. Some people are going to be healthy. So you see that 42.6% of people who have no hospital episodes. But then you get a quarter who are consistently low users, and then high users and consistently high users when you're 70 and older. And this is where a huge chunk of our healthcare dollar goes. When you look at these charts, it is hard not to conclude that this is a beast that cannot be tamed, a day of reckoning that we somehow are just not going to be able to avoid. Is that the wrong conclusion?
Now, in the USA, they are addressing this crisis.
How? By using the life settlement industry, the states and the consumers have found a way to inject cash into long-term care, which is basically a cash and care deficient system. It's pretty simple, really. In the USA, a person who has a T100 with zero cash value can get thousands of dollars and even tens of thousands of dollars for that policy to pay for long-term care, saving in the process tens of thousands of dollars to the states. In Canada, because of the prohibition and monopoly of insurers over life settlement, the same senior get absolutely nothing. Considering there was $11 trillion of life insurance sold in the USA and that about $600 billion lapsed, if the USA could have prevented 20% of these lapses from occurring, the USA could have injected $120 billion into long-term care, taking the first step towards solving the long-term care crisis. The USA is late to the game, but at least they have started and they're getting there. In Canada, this is not gonna happen. We did not even start, and we're not gonna start. Instead, our government in Canada have dictated that the value of life insurance policy is to be controlled by insurance company, and they are the only one who can reap the profit from these life insurance policies. Let's look at real example. Let's put a face to this problem.
Insurance agents and other professionals that advise them on retirement.
Well, in this Modern Living Field Report, we visit a client of GWG Life to see how their life settlement solutions benefited them.
GWG Life offers a quick and simple financial solution for seniors and their families to leverage life insurance policies they no longer want, need, or can afford. GWG Life helps maximize your life insurance so you get the most out of your investment. And the fair market value they pay can often be significantly more than the cash surrender value the insurance company may offer for the policy.
I decided to sell my life insurance policy when I learned about GWG. They gave me the information I found necessary to make a very important decision. It's a kind of company where the people just are anxious for you to know everything that you have to know to make a good decision. I would have thrown this policy away or let it lapse, but they gave me cash that was in excess of the cash surrender value.
GWG, a public...
In Canada, seniors are getting ripped off by life insurance companies. Here's a true story about a senior and how one life insurance company tried to take advantage of him. I received an email from Daniel Kama on June 2016 asking for my help with a consumer. The consumer name was Yu, and he had just been diagnosed with an illness, and his doctor gave him 2 years to live. He asked Sun Life for a living benefit from the life policy that he had with that company, and Sun Life declined. He did not get 1 penny. Now, the policy that he had a death benefit of $350,000, and he should have been able to receive at least 50% of that, so $175,000. Now, lucky for you, Khan accepted to help him by leveraging his contact at CHLIA, stating to this association that represents all the insurers in Canada that if they did not address the situation, if they did not correct this, he would go on TV and show what they were doing. Then suddenly, out of the blue, you receive $100,000 as a life settlement from his life policy. Suddenly, his life policy that had no value if he had listened to Sun Life acquired a lot of value, $100,000 worth of value in fact. The question is, how many seniors get absolutely nothing? How many seniors have to choose between paying for the costs associated with being sick versus the cost of paying a premium? How many are there that don't have access to the real value of their life insurance policy. And to access this value, life settlement have to be legal in Canada. We need a life settlement market, and the prohibition against it must be removed. Canadians love to believe that as a society and as a country that we value what is fair and what is right. In fact, we love to judge our southern neighbors, believing that we are better. Well, when it comes down to children poverty, for example, we are no better. And when it comes down to protecting seniors, we are certainly not better. This was proven in this investigation. By denying access to seniors from an important source of income that are life insurance policies, we have denied the seniors access to a source of income that they could use to improve the standard of cares that they should be getting. Behind this story, we're dealing with real people. We're dealing with real people that have lost their insurance coverage, their life insurance coverage, because of the manufactured lapses done by some insurance companies. We're dealing with real seniors that have been denied access to the real value of their life insurance policies. In fact, we have put the interests of the life insurance companies ahead of seniors. We have put the interests of the life insurance companies ahead of the finances of our provinces. And this means that we're all going to have to pay for this through increased taxation. So what I'm going to be asking you is the same thing that was asked the jury in the Rainmaker movie. What do you think is right?
I'm asking you, the jury. Just do what you think is right.